Okay, so this evening I'm very pleased to welcome Mike Head from Ethical Investors. Mike has described himself to me just while we were chatting prior to the meeting starting as an old guy who rambles, which I feel he's very much doing himself down. I'm sure we're going to have a very interesting presentation. Mike has worked for Ethical Investors since 1985. Sorry, 1995. I've just added 10 years to his age.
Much too young. How rude.
He's worked as an advisor and is also a director. And he also manages the ethical screening, which is investigating companies' activities in terms of environmental activities. Ethical investors go back a long way. They've been specialists in the field of ethical and sustainable investment since 1989, and it is their sole focus. Some other firms will offer ethical investment alongside non-ethical ones. Ethical investors just concentrate on ethical investment. So they've been involved since the very early days when it was considered slightly niche and slightly odd to want to put your money into an ethical investment. So Mike is going to talk. He said he'd like the bulk of the presentation to be questions from people. But if you do have a question, either pop it in the chat and we can come to it when Mike finishes his initial presentation, or use the reaction to raise your hand, and then we can come to your question. And if you would all like to mute yourselves so that we don't get any background noise. And for best viewing, though Mike isn't showing screen, so it's not so important, you want to set your view to speaker view. I think that's everything I need to say. So I will now hand over to Mike Head from Ethical Investors in Cheltenham.
Hello. Looks like I won't be the old bloke rambling. It should be fine. So what I'm going to do is to start by sort of going through how ethical investment started in this country as a sort of, I think it's a useful background to know where it began and how over the intervening years it's changed. And then have a look at the various items that were on here in terms of banks and pensions and the like. And then I said to Rachel about it being more questions than me talking. That's because I don't know how long I'm going to talk for. So it'll be more than 5 minutes, but hopefully less than 90. So somewhere in between would hopefully be the sweet spot. Ethical investment in this country started effectively in 1984. So next year it's going to be 40 years. I'm talking about retail investment, as in where individuals were able to access ethical funds. And it was launched by Friends Provident with their stewardship fund. Friends Provident are one of those organisations, like so many in that field, that they started in the 19th century, sort of 1830 something or similar. There were a few others, and they were very much launched, as were a lot, by a group of Quakers. And the Quaker influence in Friends Provident at that time was, as in when they launched the stewardship fund, was very strong. So they had, before launching this, they had some policies where the Quaker influence was relatively throughout the firm. So they wouldn't invest into certain areas that they saw as being inappropriate or unsuitable, and including on the human rights side. So typically your Quaker, Methodist, etc., would have a desire to avoid social ills, either smaller social ills, as in alcohol, tobacco, gambling, pornography, or wider negative impacts, at that time, oppressive regimes and armaments. So somebody on the board from the Quaker group thought, well, we like this. There's quite a lot of Quakers out there and people who are concerned. So they decided that they would launch stewardship. And it turned out that it did rather well. It's very interesting because I started working for Friends Provident in the mid to late 80s. So the early literature for Friends Provident stewardship was very grey, very avoidance orientated. So you'd got your weapon being launched and all the like. And it was very much a grey brochure. Then it slowly changed, and we got the green brochure of a little tree with some red apples in it. And then a little bit later, it went slightly more high tech because of the way that the market developed. Now, for those of you that can remember, which can only be a few, 1984, the way that the fund was set up was very much around ethical investment. It was about avoidance. So effectively, as long as you did nothing wrong, you were considered good. So no bad equates to good. So that companies that weren't involved into those areas were seen as being acceptable. And in 1984, and I always use supermarkets are a great indication of how things have changed in terms of attitudes, etc. And in 1984, if you walked into a supermarket, as against if you walked into one now, you wouldn't find any, well, you walk through the fruit and veg, there wouldn't be any organics, there wouldn't be any non-animal tested, you'd find a load of bleach and all the rest of it. There would be nothing that you take now for granted. There would be no bag for life, there would be a load of plastics, etc. So that for Friends Provident, when they started, there weren't many sort of positive opportunities they could look at. As time went on, of course, along came the Body Shop, and suddenly there was something that was actually doing something a bit more positive. People started to be aware of and cognizant of good employment practices. So companies that were involved in non-controversial areas that had good employment practices then became much more appealing as far as stewardship were concerned. And the sort of the two things went hand in hand, because it turns out, here's a surprise, companies that treat their employees well tend to be run better and tend to be more profitable because people have more involvement with the company. And the success of Friends Provident in attracting money and getting over the hurdle of people thinking, oh, how hilarious, it's only going to be people, who are the crazy hippies who are either down at Greenham Common, which was about then, for those that remember, etc. So the copycats came along, which were very similarly orientated, so very much ethical funds. And then late in the 80s, there was the first environmental fund. So a fund that obviously there wasn't the same environmental focus, awareness, or if only we'd known, urgency as there is now. But there's an environmental fund that launches that looks at what was available then in terms of environmental knowledge and opportunity. So that was more around, at that time, people were very bothered about greenhouse gases, CFCs, and stuff like that. So that was a focus. When you move on to, as time goes on, so through the 90s, you've then got a lot of tech coming along, because of course, what a world it was before we had a Facebook. But in those days, it was a sort of different level of technology and the way in which it was. But that's when Friends Provident and their literature became very much more about, the sort of digitalization of things and the way in which we all live. So that's when they went to their slightly more high-tech approach. And there was a sort of an enormous number of new funds being launched through from mid-90s to mid-2000s of various shades. Very few of them were pure and hard on the ethic. And the reason for that was the realization that clients in the main are pretty pragmatic. And if you have a total exclusion around something, it means that even a company that's doing extremely well in that area is excluded. Whereas having a sustainability focus means that you can include companies that are doing good things, and at the same time understanding that there is a need. There are various areas that sort of, as well in terms of ethics, there are your obvious expectations, but there's the thing around, for example, strategic or non-strategic, and that can be on alcohol and tobacco, because you wouldn't want a tobacco manufacturer or someone who only sold tobacco, but you wouldn't be as concerned about a supermarket, for example, where they sell some tobacco alongside food that people need to eat. And with armaments, you're looking at a situation where the best way to describe it is, if you make nuts and bolts for British Aerospace and they use them in their weapons, then you're a strategic manufacturer. If you're someone who makes nuts and bolts that happen to end up in their weapons, and you didn't even know it had happened, then that's non-strategic. So that's why companies changed, and as environmental issues came more to the fore, there were then a good number of funds being launched with very much an environmental focus, because it's fair to say that the investment industry was ahead of the game in terms of an awareness of where we were heading in terms of the environment, and certainly an awful long way ahead of governments. No surprise there, because governments are still pretending it's not happening, as our glorious leadership have shown us just this week. So that's very much how it has changed in terms of the marketplace. So new funds being launched with an avoidance criteria are not as common. The other thing that's happened is that there's an expectation that, well, of course you're not. Why are you asking me if I want to invest into weapons or into tobacco? Because of course I don't. The expectation is that those things are taken for read, and that you would move beyond that, and that you would be looking at other areas. And of course, in a world where it isn't only about the environment, there are lots of social issues, whether that be health or education or housing, etc. All of these have an impact, have an opportunity. It is a difficult thing sometimes to gain an investment into some of these areas. A conversation I have quite often with clients is less so now, but more previously, would be about fair trade, where they would want to know if it was possible to invest into fair trade or even into organics. And one of the things about fair trade and organics is that they only really work in a relatively small scale, because the last thing that would work would be an enormous farm that's run on an organic scale, because it tends not to be viable. And when you know the size of the sums of money involved, the biggest fund manager exclusively in the sustainable field has about 40 billion under management. So they don't tend to be looking at small sums of money. And so they would easily be able to buy and then distort the whole market in that place. So there's certain areas that you need to look at if you're a saver or as an investor as not being possible to achieve except either by shopping, by your attitude to those things, or by localized investment areas. And having raised that topic, I might as well go straight in there. That sort of community-based investment is fantastic in terms of impact. I think in many cases, they're absolutely outstanding. They're very difficult for advisors to advise on. And what I'm talking about there is the sort of the small local community-based, whether it be a solar park or a wind farm or something similar. There's some really fascinating. There was one in Oxford, which was a hydro scheme for water, almost in the centre of Oxford. Those tend to be relatively small sums of money, so they are much more around small individuals putting in sums of money. You can find out about them from Triodos Renewables, from FX, from Abundance, etc. These are all sort of platforms that will give you a window into those sorts of areas. Advisors won't tend to recommend them. We used to, and we don't anymore, because it's impossible for us to be able to properly carry out the necessary due diligence. The other thing that you'll find with those is they tend to have quite a good rate of return. It's not as attractive now because, of course, building societies are desperately trying to pay you 5 or 6%. But for the last 15 years, they've been trying to pay you 0.1%. So that organizations in that area tend to have reasonably good rates of return. And it's now a sort of established technology. I'm not endorsing or recommending, so please don't tell me if it goes wrong. But that is the reality, that these sort of locally based small solar parks are viable. The two caveats: firstly, obviously, don't put too much money in, and secondly, if they're paying a rate of interest that looks too good, you have to ask yourself why, because it doesn't seem necessary. If an organisation is running a solar park or a wind farm in Malvern and they're going to pay you 6%, why do they need to pay more? Because you'd be more than happy, as a sort of person who's motivated to put money into that sort of area, to just be getting 6%. So that would be the only thing that I would say is a little bit of a flag. It doesn't mean there's anything wrong with them. It just means it's sort of an odd business model, and having to pay those rates of return tend to put a strain on the organisation. Now, the marketplace has gone from being quite simple with ethical investment to becoming a bit more complicated with environmental. And now we have a plethora of new, lovely three-letter acronyms. It's sort of like the government during COVID, only they mean almost as much. So you have ESG, which is environmental, social, and governance. You have SDG, which are the Sustainable Development Goals, which is a United Nations initiative. And you've got a load of others. Net zero, you've got the journey to net zero, if you like. I'll explain what that is and why it's not working the way people are assessing it. And the thing to bear in mind is ESG is a term that's used extremely widely, and it is very confusing because it's not what people expect it to be. ESG is an assessment tool that asset managers and people use to assess the risks to a company of environmental, social, and governance legislation. It does not take any account of what that company does. So as a consequence, there are some oil companies out there that get a fantastic ESG score. But what they don't do is to point out that they're an oil company. And even more surprisingly, there are some British American Tobacco, British Aerospace, that score relatively well as well on an ESG score, without pointing out that their business model is around killing people, which I sort of see as being not that strong from a social or a positive impact perspective. So be careful if you're looking at something that has got an ESG label attached to it, because you need to know that it means a little bit more than just having the label attached. The SDGs are a thing that the UN launched, the Sustainable Development Goals, and they're very interesting. They're a set of principles. There are 17 headlines and 169 underlying themes behind them. They are looking at areas that the UN has identified as being in need of attention. Now, many of them require government attention, but they look at different things. So they will look at good employment, they'll look at environment, they'll look at water, etc. They are a useful indicator, but again, big companies that have quite large organizations behind them that are able to put together the data are very good at making sure that their ESG and SDG score comes out well. You need to look a little bit further because there are some countries in there that you would look at slightly askance. One of the things that's very topical, particularly because the Financial Conduct Authority, the regulator of the whole financial ecosystem, is around greenwashing. Greenwashing is a bit of a scourge. It's making claims that are not actually necessarily possible to prove. It's, dare I say, putting lipstick on a pig. It's something that people have realized. The example I like to use, it's a few years now and they've changed the holdings, but there was a company that had an ESG climate change fund, and at number 4 and 5 in their list of holdings were Chevron and Shell. Now, let's be fair, they are going to change the climate. They didn't say whether in their label on the fund that it's going to be for the better or for the worse. But you need to be aware that that really is what's going on. That there are a lot of funds out there that are doing an awful lot of good. There are some new ones that are doing a lot of good, and there are some old ones that have changed the name but nothing else about the strategy. Hopefully, the Financial Conduct Authority is introducing a label system that will be, well, they were going to do it in the summer, but it's been put back. It should be this year, and you will not be able to use a term like impact or sustainable or etc. if you are not able to credibly prove that that's what you are doing. Now, I'm guessing as a group that you are more leaning towards the environmental, but that doesn't mean, and I suppose it's because you assume that the social is already taken care of. You're not imagining that your environmental fund is going to have no concerns for landmines and child labour, because that would be kind of odd. What's a future we'd be looking at? But there are lots of niche funds that are being launched as well now. One that I'd never encountered, I saw yesterday, which is an oncology fund, which is obviously a pharmaceutical company that is specializing in research into undeliverable drugs in that area. It's an interesting concept, and in a world where governments aren't doing that anymore. Remember the days when universities used to be the ones who did the drug discoveries? That doesn't happen anymore, does it? Because we don't need that. We want it to be private organizations, BioNTech, that make huge amounts of money out of selling drugs to make sure that the world doesn't die of COVID. But we'll try and turn down the social commentary. So that's sort of where you are at in terms of how the world has evolved in terms of funds. As I say, that you've gone from 1990, when just after when we were launched, there were probably half a dozen funds. There are now north of 300 that have a genuine sustainability approach. There are vast numbers that are using some sort of ESG overlay theme or trend or something similar. Many of those, as I say, will be the ones who simply look at an ESG score and do nothing more than that. Now, that's better than not doing it, but effectively that is a risk tool. It is not something that is going to lead to an outcome. It will mean that for them, if you're a well-run company, you score well, regardless of what you do. So you need to be aware of that. And of course, I'm talking here about investing funds rather than savings. So this is very much around our world as advisors, which is, if you meet you as a client, we will talk to you about where your money is, what you need it to do, and then we will go through and we'll say, okay, the building blocks are, you start with cash. Once you've got enough cash, you can start to build on from there. And these are the things that you are then adding on to constructing a savings and investments portfolio. Looking at cash, which is already something that's on there, the difference between banks and building societies is very simple. Building societies are only allowed to, as in a building society, so it has to be a mutual society. They are only allowed to lend money for personal loans and for house purchase. They're pretty much stuck there. They are not allowed to lend money to businesses. So although I think it would be kind of extraordinary, and in a way I'd applaud it, if someone took out a personal loan to build an arms factory in their garage, I think it's quite unlikely. So from an environmental social perspective, if you stick with building societies, you're not going to find yourself with a moment of thinking, oh, they're the people who bank, who underpin, who are paying the development of whatever it might be, whether it be weapons related or environmental damage, etc. You're not going to find them being the ones who are doing something in that area. Obviously, that excludes, I'm not sure whether Co-op Bank anymore. I don't know if they're good or bad. It confuses me. Triodos is an environmentally acceptable bank. They're very good on the banking side, so we don't have a problem with them, and they're probably one of the few in the banking area who are not only one that are favourable, they are also very transparent about a lot of the stuff that they do. So in terms of banking, that's one of the things that is certainly one of the ones to look at. And because of the way in which the banking sector has changed, it used to be that you sort of needed a bank because the building societies didn't offer the banking services that the building societies didn't offer the banking services that the banks do. So that they were great for savings and the like, but they weren't really that capable around the standing order, direct debit, current account, etc. If, and I'm sure you all are, you're international travellers who spend a huge amount of time out of the country, I don't know that you'd want to get stuck in South America trying to log on online to your Ecology Building Society account. So just in case, you might want something a little bit more sophisticated, but outside of that, these days you can pretty much run with a building society. And they also now have some savings accounts for businesses as well, which means both, and business accounts is not just businesses, but it's also charities. So that's quite a useful one. Having mentioned them in the world of building societies, obviously setting aside the Staffordshire Railway, the Ecology is the one that sort of leads the way, because not only do they only lend on houses, but they only lend on either environmentally friendly houses, or on, if it's going to be new build, it has to be something pretty extraordinary and has to have an awful lot of strict environmental criteria applied to it. I mean, interesting with the ecology, they historically have lent on that, or on terraced houses, because terraced houses are existing housing stock, and because of the way they're constructed and the fact they're attached, they tend to have a much lower environmental footprint, etc. So that's not really an advert for the ecology, but we do like them very much. What's next? Pensions. Well, pensions for pensioners. I'm going to get my state pension next week. Yay! How exciting. Pensions is an interesting one, because I was saying this to Rachel earlier. If you're a member, there's a number of ways. If you're a member of a pension scheme, so you work for the local authority, or you work for the university or similar, you are a member of a scheme where they have a fund behind them. So it feels a bit distant. If you work for the health service or in teaching, in the main teaching unions anyway, or the civil service, there's no money behind it at all. So you haven't got the thing. The USS, the University Superannuation Scheme, has one of the biggest pension funds in the country. It's got some issues. I think we do that one in inverted commas. They have a very large ethics unit that looks at the issues around where their money is invested. They're much more involved in engagement than they are in avoidance, because the difficulty there is you have an enormous constituency, and it's difficult to say, because you have a fiduciary duty, if the people there made a decision that they weren't going to invest into a particular area, that if they said tobacco, well, if 10% of the people in there smoke, and they say, we want to be investing in tobacco because it's quite profitable, they would have a problem there. So it is much more around trying to effect change through engagement. And engagement is effectively asset managers, whether that be pension funds, but also the big asset managers. It's talking to companies about what they're doing. It's more about transparency than it is about changing the actual activity. It's a source of great entertainment that the number of people who say they're engaging with BP in an active dialogue, and you think, well, there must be so many people talking to BP and so many people at BP being talked to, but not much seems to change. So if you are in that environment and you're being told, oh, we're engaging, the question I would like to suggest you ask is, can we see the results? Can we actually see where you've had a win? Where you've had a conversation, and it happens, there's no question about that. It's not always in the way that you'd want. It isn't always at the speed that you would want. But there is no doubt that sometimes engagement works. It doesn't work as much as campaigning does, because most organizations don't like being embarrassed, which is why campaigning works. But some, it doesn't work as well. So if you're a member of one of those types of schemes, that's where you are able to apply some pressure. And most people are bothered. It's kind of a curious thing that there are pension schemes that are holding vast sums of money for people's futures, and they're investing into companies that are going to make sure the future's pretty damn hot and not necessarily livable, which seems like a strange way to approach it. So applying some pressure there and making that point, which is, if you're investing for the future, can we invest in the future? Because although the last year, 2022, was not a great year for sustainable investing, and it was a great year to be in oil, coal, utilities, etc. Prior to that, they were not great places to be. And if people think the future's investing in oil, then good luck, because it's not going to make money, and it's going to mean that you're going to need some factor 200 for your suntan cream. The other part of the market is obviously individual pensions, where people have the ability to make a decision, whether it's a personal pension plan or it is a workplace pension, etc. And there are lots of opportunities there to invest, to both avoid and encourage. So it's a relatively easy thing to find yourself. The same as with an investment portfolio. So if you have stocks and shares ISA, it is easy to find a way to access so that you're both avoiding areas that you would find unacceptable and encourage areas that you would find of greater interest. And certainly it works in terms of the way in which the asset managers don't like being challenged on these things, and they don't like people asking pesky questions. They'll tell you that they love to engage with but they tend to have a bit of a we know best and don't you worry your pretty little head, which is a source of some fascination to me when some of my clients are professors of environmental studies and the like. I've got one client who helped two of the governments in the Far East to write their net zero and transition policies, then being told by a graduate at a pension company, don't worry, we know about these things. And you think, do you? You do know that I was the person who was actually lecturing you. Who are the charities which allow, oh, I nearly saw that question, but I missed it. And that's, where am I going to go next? I think that's probably most of what I'd like to share. But I've been rambling on for over half an hour. I've done well. I haven't said anything rude or controversial or, in fact, litigious yet. Give it time.
Well, thank you very much for that, Mike. It was very interesting. And we've had a few comments in the chat, one of which is, can you repeat where we can find out about investing in local schemes? You mentioned, I did scribble it down and I can't see it. Triodos, FedEx and Abundance.
No,
Maybe
no, Ruth, sorry, not FedEx.
Sorry, FX.
FX,
I wrote down FX and read it out as FedEx.
I love the idea of FedEx. They'll deliver your wind turbine, but you'll be out, so they'll probably just leave it on the doorstep.
So maybe you could send me those links after the meeting and I can circulate them to everybody.
Edward has just posted one of them.
Oh, yep. So, and Ruth has asked about the building societies that allow charities to have accounts. And I know that for some of the groups who are HGN members, this is quite an issue, finding a financial institution that will offer charities a bank account. And she also asked about teachers' pensions.
Okay, I use Money Facts as a search engine, as in Money Facts, as in FACTS, as a search engine. They all have the same thing, and if you go there, there is along the top line, there is there's a business line, and it's got all business savings. Now, if you go to all business savings, you've got the first one out is their banks, and it takes a while till you get to, oh God, please find me one. There must be one. There was. The Buckinghamshire Building Society. There you are. The Buckinghamshire Building Society has got a fixed rate bond paying 3% for 12 months for charities. There are some on here. I have no idea who the ICICI Bank is. It sounds like a comedy routine by Morecambe and Wise. That's one for the youngsters. There are some banks on here that you will never have heard of. You know, the sort of the UBL and recognise? I don't know. But as I say, if you go on there, you can find the various organisations who do that. It is something that there are not that many that offer it. I think Metro Bank, who offer, have been, there you are, the Cambridge and Counties, yeah. So there are a few. It's not their major area, so don't be disappointed when you don't find lots on there.
We have had, Richard has said that for charity accounts, he uses Unity Trust Bank. He says they're very good, but they do charge a small amount.
Yes, Unity Trust is one that is quite a popular one. Some people use CAF, obviously, that's Charities Aid Foundation, because they have some accounts as well. So there are options rather than rather than ending up going into one of the high street banks. There's a there's a whole world. The banks are interesting. The banks are very aware of the fact that they have an issue. They're all trying to say they're going to get to net zero with their lending policies by a certain point in the future, and then they go ahead and lend a load of money to fossil fuel companies, which is kind of interesting. On the just one snippet on the net zero thing. Cath no longer considered ethical. Interesting. Ooh, okay. Boo to them. I mean, between me and all of you, I'm not a huge fan, but that's another matter. That's because I think they charge too much for their charity for people to make donations, but that's the thing. Okay, on the net zero thing, I don't know if you're aware of this. It's quite an interesting one in that we're going to be net zero by a certain point. This is where I ought to have a screen share. If the journey to net zero is that you're going to go in a straight, so this works on the screen. If you're going in a straight line all the way along and then you get to net zero at the bottom, that isn't how you need to do it. You need to be going across like that. So you need to be on an axis like this for net zero, because if you're going like that, then the amount of impact that's being achieved, this is so high tech, isn't it? Because effectively you haven't really made a difference. And it means that the acceleration that has to come in at the end has got to be very dramatic. So all these countries who are saying we're going to be net zero by 2050, they're not doing it in that way, or very few of them are. And that's the most important consideration, because otherwise all the calculations around what we need to get to in terms of temperature and net zero are based by the scientists on that. And of course, people are saying, oh, no, we'll be net zero. It's like, well, are you sure? Maybe you will in 2050, but by the time you get there, the amount of heating that's going to go on it, the amount of planetary is going to be significantly greater. So if you have somebody telling you that at whatever level and in whatever capacity, ask them the question. Because if they don't know that, that's quite embarrassing. If they do know that, then they should be aware of the fact that it can be done in a proper way, is a way of putting it.
So can we go back to Ruth's point about teachers' pensions? I mean, presumably that's similar to local government pensions, that it's invested in a fund and you don't really know where it is. No,
there is no fund. If you're part of, I think the NSUWT have a fund behind them. I think maybe one of the others, but the main teacher's pension, it's one of those oddities that where the local authorities, I don't know about you, but where I am in Worcestershire, the local authority has about 1.3, 1.4 billion in underlying assets. The teacher's pension doesn't. So it's kind of odd when you see public sector workers marching through London are talking about pensions, and you've got someone from the USS, someone from local government, and someone from the teachers, because there's nothing. It is like the state pension. It's paid out of taxation.
Okay.
So as a consequence, Avara pensions. I don't know what Avara pensions are. Did you mean Aviva pensions, or what's Avara?
Maggie, are you talking about what was Sun Valley? Aviva. Okay.
Aviva. Okay. Yes, you can. What's the question? If the question's about Aviva in general as an asset manager, they are viewed pretty well. They're pretty enlightened. They're better than most. They're very transparent. They have a range of offerings. They're not perfect. If it's a specific question about Aviva, it's kind of interesting that their chief exec is a woman, which is fantastic. She's unexpectedly, I know this is kind of a shock to the females in the meeting, she's subjected to some extraordinary levels of misogyny. The assumption that she's going to make the tea. What are you doing here, love? She thought that to ace that element, she would take over. She resigned the position, but she did some work for a while for the Welsh Rugby Union. If you want to look up how well that ended, she told them that their culture was not at all acceptable or appropriate across any of the matrices that you'd look at. And next thing you know, look at what happened. That sort of, what do you know about governance? Okay, I don't know much about rugby, but I know rather a lot about governance. What do you? Very little. Okay, thank you very much. Aviva, as I say, of the asset managers, they have quite a lot of funds that fit within various themes. They are, and they look across the whole piece. They've done a very interesting thing, which I think is quite clever. They identified, not within the sustainable or ethical or anything else, they identified their investments, the 30 most impactful in terms of the environment. So they've identified they called it the dirty 30. There's a catchy one. And they are engaging with those dirty 30 to give them a timescale in which to see some improvement in their activities. And I think it's very clever, because the idea that we're just going to ignore the dirty ones and, embrace the clean ones is all very well, but actually to highlight and to work with and to try and get the others to change, and then to be very public in the fact that they haven't. It's something that CCLA, which is the Church Commissioners, it's basically the Church of England investment arm, they're doing as well. That Church of England lot, they're getting quite punchy, and they are saying the same thing. Okay, they're saying the same thing in terms of engaging with companies and then saying, if we disinvest, we're going to do so publicly. So we're going to make it clear that we have been talking to you. We've been highlighting the issues that we think are important, whether it be social or environmental or governance related. And when you don't make improvements that we believe to be essential, we will both disinvest and we'll do so publicly, which I think is a great idea. Someone's asked about NS and I and the comparison of building societies. National Savings is effectively the government bank. It's a very useful place if you're worried about the £85,000 limit, or you've just sold your £1 million house and you don't know where to put the money while you're buying a new one. It's the place that I always recommend, because you shouldn't have to worry about the compensation scheme unless the government goes bust. And there was a moment about a year ago when Trussonomics took over, although we were all wrong and she was right, where we looked like we might even be teetering on the edge of that. National Savings is one of those things. It's effectively you're lending money and they are paying a rate of interest on it. Premium bonds are tax-free, so they're quite fun, if you like that sort of thing. And it's not gambling, because you don't lose your stake. So that unlike all of the other things that would be seen as that, it's not a lottery, because you can have your money back when you haven't been a winner. It then becomes an issue around tax, because you are sort of lending money to the government, but assuming that you're not a aggressive say no tax paying campaigner, of which there are some, then it would probably be okay to be using National Savings. And they have a green bond that's paying 6.2, I think, at the moment. So that's definitely something that has some appeal. On the tax campaign side, we had a client who would calculate every year how much money was spent on defence, and he would send his tax in minus that amount and would say, I'm not paying that 12% or that whatever percent it was, because he didn't think it was appropriate. And about every 2 or 3 years, they would take him off and they put him in prison for a month. And he was a bit of a cause célèbre, because he was a very entertaining gentleman. And all the prisoners who'd been here long term would say, lovely to see you back, how have you been? And a month later, he'd go home and he would go straight back into the same routine. And you think, well, good on you. Slightly out there, but if that's what you want to do, then why not? Got a call?
Yes. So we've got one query in the chat, and I can see that Susanna would like to ask something. So the query in the chat is about water companies. Are they considered a suitable place to invest with all the pollution that they're causing?
No.
Well, that was a quick answer.
It's a very difficult one, that one. I think some are better than others. I would imagine that the view amongst pretty much all of the 5.7 on the National Savings Green Bond, I fibbed. Water companies were for a while seen as being okay. I think that most of the investing companies have been shocked to discover just how not okay they are in terms of their attitude towards sewage and the like. And the discovery recently that not only are they saying, "Oh my goodness, it's raining so hard, we've got no choice then to release," but now they're releasing sewage when it's dry, which is sort of like, I think someone's asked an ESG question about that. That would be a different matter. I don't know. I would imagine they would probably be considered okay-ish.
And Susanna, you wanted to ask a question.
Yep, I did indeed. This doesn't apply to me, obviously, but if you are an employee of an organisation that subtracts a certain amount of your salary every month and puts it into a pension fund, and you have no access to what that pension fund is investing in, or you discover that it's investing in things that you don't want to, are you able to, let's say, prevent your employer from putting the money into that pension fund? And can you take that money out yourself and put it where you want to? What's the situation on that?
If you're a member of a pension scheme of that sort, the likelihood is that I would imagine it would be a group personal pension plan, because most of them are, and you can select your own funds. So it's relatively easy.
But if your employer is putting money in, do you mean?
Yes. Unless
right. Okay.
there are very few employer group schemes these days that aren't just collectives of individual personal pension plans. So the workplace pensions that most people are members of, they will be, the employer will have what's known as a default fund. So the employer, in conjunction with the pension provider, will choose a default, and it may be a single fund, it may be a range of funds. We do that for people, and within that you are able to self-select away from the default. And in fact, the employer wouldn't even know you've done it, because your relationship is, while the employer is choosing the default as an individual. So for an example, with Aviva, if you have a group pension scheme with Aviva, you go onto My Aviva, which is the access point, and it's an app or it's online, and you can simply go in there and you can say, well, I don't want that, and you can find funds that are available that would be suitable, either from Aviva or from external providers, that would fit within your fund. Alternatively, it is possible to transfer to another place and then to take control of that. I see somebody pointed out that they're with Hargreaves. Hargreaves has a whole section on their website of responsible, sustainable, etc. funds. I don't know how they rate them. I don't know what methodology they use. I'm going to find out now, aren't I?
Thank you. Thank you.
Hargreaves Lansdowne. As I'm not a member, I don't know how much access I would have, but I know that they have a list. They always have a list of funds, and they will have something along the sustainable, etc. I would, as I say, I would stay away from funds that only have an ESG label on them, because they won't have a particularly strong sustainable theme. But there are lots of sustainable funds out there that you can use, and I think that Ethical Consumer quite regularly and frequently, irritatingly, I could say sometimes, because some of them are a bit skewed, but they have a list of funds. They have a list of ethical advisors as well. Obviously, we are championed, but Ethical Consumer do produce a list of funds, and they give you a breakdown, so that they will give you an idea of thinking, okay, so they'll rate them according to different things that they use. Yes, they do, but you can't find them on HL. Well, these people doing research while I'm talking. But yeah, I think that there's been one in the last few months that Ethical Consumer have produced that looks at funds, looks at whether they're any good, where their strengths and weaknesses lie. It's not perfect, but it's an awful long way away from imperfect, and it gives a really good steer around that. And if you're looking at self-selecting, which somebody on Hargreaves would do, then the thing to do there is to then, if it highlights and you look and you think, okay, these people at Web or Impacts, I'm just throwing out names there, if they look interesting, then I'll go onto their website and do my own research, and that way you find out. And if you look at an ESG fund, if you just look at what they do, you will very quickly because of your interests and knowledge, you will look and you'll think, oh, really? That seems unexpected. I wouldn't have thought that company would be in there. Or you'll think this all sounds good. And that way you can, if you are self-selecting, you'll be able to get to that point fairly easily.
Can I raise a query, which I imagine a lot of people ask you, which is how do the rates of return on investments compare? I mean, do people come along to you thinking that ethical investments are very nice, but they're going to pay a worse rate of return?
The assumption is, and it's an industry-wide thing, I think it's an industry perpetuated thing as well, which is that if you have exclusions, then it is by its very nature making it likely that you will have inferior returns. And that is utter nonsense. There are periods, and as I alluded to just now, there are periods when sustainable funds that can't and won't invest into areas that do particularly well, they do worse than conventional non-restricted funds. But overall, that has not been proven to be the case. If you do a search for how do ESG funds perform, how do sustainable funds perform, etc., there have been any number of, I mean, seriously weighty, peer-reviewed pieces of work and carried out by organizations that are not looking for the answer that came out. They're just looking for a genuine answer. So it's not something that's been done by The Guardian. There was one done by Deutsche Bank, there was one done by Paribas, so big financial institutions that seem fairly soulless and aren't particularly bothered about the future of the planet by their lending practices. Oh, that's controversial, so I'll retract that one. But if you look at those, they confirm over and over again that restrictions are not the thing that makes the difference. It's the quality of the fund management. And if you look at some of the funds that have performed extremely well, they are within the sustainable space, they have done at least as well, if not better. There will always be a niche fund that is the leader, because at the moment, if you've got some sort of decent product around AI, the share price is going through the roof because everyone knows that AI is going to be the future of everything until it's not. And that happens with any number of areas like that. So that there are when you're into those sorts of niches, that's what happens. But in an overall sort of balanced, managed fund where you're looking at investing in the US or Europe or something similar, those tend not to be significantly outperformed by their peers. And if you look at the fact that the majority of the industries you'd want to avoid, many of them have got some serious problems. The issue of stranded assets is one that the oil companies will continue to try and ignore, but the reality is it is something that's going to happen. And it's something that even people within the oil industry acknowledge is going to happen. So there's going to come a point where the share price has got to suffer for the fact that nobody wants the product anymore. And it's interesting, BP, going back to Bernard Looney, the ex-chief, can't imagine why he had to leave, he said relatively recently that one of the issues they struggle with at BP is that when he started 30 or 40 years ago, whenever it was, working for BP was a bit of a what a shot. You know, it was a great thing. You go home at university, you're going to BP. They now struggle to attract the brightest and the best, because that thing of being at a dinner party these days and saying to somebody, oh, that's unfortunate, rather than, oh, outstanding, because they're always concerned that somebody around the table is going to say, oh, good. So you're the ones who are flaring in southern Iraq or something similar, and they have to defend deep water or whatever else it might be. And there is very much a push against that in terms of investment. The weird situation that arose when the, what's it called? The war, that thing that's happening in Russia and Ukraine, when that began, we had this immediate reaction of thinking, energy security. Imagine if we'd been building those wind turbines onshore, Tory party, thank you, and putting some more resource into solar wave. Imagine. Then we wouldn't have said, we're not going to buy Russian gas, we're going to buy Qatari gas. We would have been able to say, we don't need to do that. A lot of European money has been directed towards, as in government EU money, and in the US as well. They've got this IRA, but it's basically a Green New Deal. They have put an enormous amount of money into that area because they see that as being essential. Because energy security isn't going to come from buying it from somewhere else. It's going to come from generating it ourselves. And so those technologies, surely that's going to be the place you want to be investing in the future, whether that be solar or batteries or the like. I had a meeting earlier, I say, with a woman who works for a company that they are making large-scale battery storage. And so it's a subsidiary of the Norwegian oil company. And so they look like containers. They look like the sort of containers you see on ships on the back of lorries, about that size. And they are now, the starting point for those has been that they put them in locations and they use them to top up off-grid. At low, so a bit like you do with your EV car, that you charge it up overnight and then you get the low rate. But they're now building them alongside alternative energy power sources, so that you have a solar array that's charging up this massive container-sized battery that then feeds back into the grid. So it's the perfect scenario. It's the thing that it's what the California dream was until California got too hot for anything to work properly, which is that you've got these solar panels on your house, you've got your battery inside, and you've got your Tesla outside, and the battery that you're powering yourself with free power is the thing that charges up the car and runs your aircon and all of your appliances inside the house. And it's that's part of this whole circular economy, donut economics world that would be kind of nice, and that bizarrely a large part of the population yearns for, and a small part of the population doesn't want. And so GB News wins, and we don't have any of it. It's a funny world, isn't it? Questions?
Just going back to the question to the chat, Jim has asked, what is your opinion re Vanguard?
Okay. Okay, Vanguard is a nice adverts, by the way, on the telly, aren't they? Vanguard is it's an American organization, sort of like BlackRock, only not quite as big. They are passive. Okay, in the world of investment, you have active and passive management. So active management is where you choose companies. So you have a fund manager, a bit like a stockbroker, and they say, we're going to invest into Sainsbury's, but not into Tesco. We're going to invest into Vodafone, but not into O2 or whatever else it might be. That's active management, where somebody is there, you pay more for it because there is somebody that is researching companies and is buying and selling on that basis. With active management, that's how it's easier to construct a portfolio that either has avoidance criteria or has positive themes, etc., of whatever nature. Passive investing is effectively following an index. So with passive investing, you are just saying, okay, I am going to follow, you're investing into the FTSE 100 or the Dow Jones 500 or the S&P or whatever else it might be, so that you're not actually choosing which one of those you invest into. You just follow that index. So if the Dow Jones goes up by 10%, your money goes up by 10%. Because there's no active management involved, they are less expensive. The two issues there relating to, particularly to Vanguard and to even more so to BlackRock, is they are huge in terms of the amount of money they have invested. BlackRock is the largest investment company in the world. And it's an interesting journey they've been on. But because of that, they have a huge amount of influence that they sometimes choose to use and they choose not. The man who runs BlackRock had always been very much, it's not our job to try and make decisions about that and to try and influence things. He had an odd sort of conversion, epiphany a few years ago, not that many, where he decided that actually BlackRock was concerned about these issues, which in Trumpian America got a lot of blowback from the Republican right. And also with the war, where oil and gas and coal became very profitable, they changed. So he went from, we're going to highlight these issues, to we're not going to highlight these issues. The thing with Vanguard is it's low cost. but it doesn't apply any particularly stringent policies around those things. One of the difficulties as well is because they follow indices, there isn't really a particularly effective index to follow that means that you can avoid the things that you would want to avoid. There is a thing that's been running for quite a long time in this country called FTSE for Good, but if you look at the constituent parts, you might not feel quite as good as you'd hoped for. Probably covers it.
And Jean has said that her experience with her private pension is that the ethical option has performed better than their general option. So that's their general offering. So that's a really positive result, both for her and for ethical investing.
Interesting enough on that front, we looked a couple of years ago at Nest. Nest is it's a provider of workplace pensions for people who it was sort of government sponsored, not necessarily backed, and they have a relatively small range. They've got a Sharia fund, they've got an ethical fund, and then they've got others that aren't. And at the point that we looked, the best performing funds were the Sharia followed by the ethical. So it was that element of, oh, that's interesting, isn't it? So if you looked at the end of 2022, the ethical funds would have looked horrible on a 12-month performance, but over 10 years they look fine. And unless you're investing for the very short term, it would be very odd that the things that people don't really need become the things that are the most profitable.
Yeah, I would agree with that. Over 10 years, looking at my Aviva investment, it's over 10 years it's done pretty well. There have been ups and downs. So, and she's also asked, what do you think of the private office? Oh, and Paul would like to ask a question. Oh,
what? No, he's saying good. I think he was saying goodbye.
Oh, right. Okay. I thought he was raising his hand to ask a question. He's obviously saying he's got to go.
I'm guessing that was goodbye, or either it's gin o'clock and I'm on my way. What's a private office? Is that like a family office?
Rod has asked what's Sharia. That's Islamic investment, yes. Because they have very strict rules about investing.
Yes. And the reason that they done well, because effectively, if you think about the Sharia-based principles, the things that they avoid will have been things that didn't do very well. So, for example, there's no gambling, there's no banks because they don't believe in lending for interest is usury, so that's not appropriate either. So that, if you have a look at, Sharia funds are very interesting things to look at in terms of the underlying principles, because of course many of the countries that have Sharia funds are ones that have fossil fuels, so they wouldn't necessarily fit very well. It could be argued they have interesting views on women, but that's not for me to say. Yes, I went to a presentation once which was about Sharia mortgages, and one of the people doing the presentation was a woman who talked about her traveling to Muslim countries as a woman presenting on Sharia mortgages and the like, and how interesting that challenge was. Someone's just said what the private office is. I've got no idea.
Yes. An investment advice company recommended by Savings Champion.
Okay, I'm completely lost now. I don't know who Savings Champion is. The private office. Isn't this fun watching me trying to Google online? You might as well get the wine. The private office is an independent financial advisor. Oh, there you are then. They've got an 0333. God, what telephone number? I know nothing about them. I can't say whether they're good or bad. I'm sure they're lovely. Well, I hope they are anyway. On what basis were they recommended, just out of interest? I mean, the thing is, I can't really get cross.
They send out weekly advice on banks, building societies, etc., and savings rates. That presumably is the Savings Champion who does that. So a bit like
sort of a Martin Lewis.
Martin Lewis, yes.
But not as trusted as Saint Martin of Lewis. Indeed. Okay. Yep.
was just
The private office is loading very slowly, so I don't really know. But as I say, if they're a firm of independent financial advisors, they're sort of like us, but not the same-ish.
I wondered, Mike, if you'd like to just talk people through in general, if they approached you or the private office or a similar ethical investment firm, what would be the process that you would go through with an individual client to find out what their preferences are and where they would like to invest and what they want to avoid and so on? How does that work?
Oh Lord, we don't want people
briefly.
No, we don't want people approaching us. That's not how it works. It's Euro Millions winners and nobody, and the Kardashians. That's all we're looking for. Okay. Effectively, what we do what normal financial, what conventional financial, I say normal because we're not the normal. We do what conventional financial advisors do, which we look at all the usual things like, obviously, how much money have you got? What is it you're trying to do with it? Your attitude to risk, your time horizons, what debts you got, what responsibilities you have, etc. The bit that we add on to that, and funnily enough, we're moving away from it, but historically, we have always asked people to fill in a questionnaire. And the questionnaire is for them to highlight whether they have a must avoid, avoid if possible, or not really bothered. And it goes through in alphabetical order, and it's alcohol, armaments, basically it's your bombs, booze and fags and stuff. And we then have the boxes that people tick for positives there, whether they're bothered about environmental issues, employment issues, etc. The key differentiator is animal experimentation, because here's a shock: not many clients tick a box saying I want to invest into arms. We've never had anyone who said they want to invest into tobacco. We've had one person who had an interesting answer to pornography that I'm not going to share. But in the main, our clients have an assumption that on the avoidance side, they would want to avoid pretty much the same things. And as I say, the key and only differentiator is around animal experimentation for medical purposes, because sustainable and ethical funds don't invest into factory farming. They don't tend to invest into any of those types. They wouldn't invest into fur. They don't like an exposure to cosmetic testing, etc. Animal experimentation for medical purposes it's one of those red lines, understandably so, because for some people it's their most important issue, or one of the ones that they would put at the top of their list. And as a consequence, we run portfolios that have that as one of the considerations, and we have other portfolios that do not. And the reason that we have stopped asking those questions is because pretty much everyone wants all the positives and pretty much everyone wants the same negatives. So it seems kind of pointless to keep. And we have had a little bit of comment of, why do you keep asking me if I want to invest into bonds? Because I'm never going to change my mind. So we sort of don't ask. The reason that animal experience is important is because it crosses more boundaries than people would anticipate. We don't get daft about it, but looking for avoiding. There you are then. That would be the one. But it is that thing that fundamentally, if that's the most important consideration, it is possible so to do. There are a small number of funds that do that. But it has a tangential overlap, which is oddly, because a lot of environmental technology comes about with engineering companies. And engineering companies sometimes have an unexpected link, not by design, with experimentation. So some of their products are used, and as a consequence, so one of I mentioned Impacts, which is a fantastic environmental fund that has any number of really interesting initiatives and manners in which they invest. But unfortunately, some of the countries that they hold, not a large number, but a small number, have some quite weak links to, Susanna's going as well, to the to experimentation. And it's that thing about, I understand that it's a red line and that you wouldn't want to be investing into Glaxo. And so that is one of the things that we have designed in terms of a portfolio. It's also interesting on experiments how there has been a bit of a change in people's attitude towards pharmaceutical companies, particularly post-pandemic, because people have realized that jab was quite handy, and the nice people who didn't make a profit out of it, it doesn't seem so bad. As somebody who has a dog, I'm not that keen on someone coming along and saying, I'm going to experiment on Rolo. And I don't think Rolo will be very pleased either. But luckily enough, they're not going to get him. I say, so that's why we tend not to go through that process. We're very transparent about the funds that people get. We are building a greater level of exposure in terms of information, so that when you have a portfolio, you will then have, through our website, you will have links to the underlying funds, what they do, how they operate, because the information that you get from financial advisors and from financial organizations tends to be, shall I say, dull, and it doesn't particularly engage. And it's really disappointing, because they tend to invest in some really interesting companies, but they don't seem to think it'd be a good idea to tell anybody. So it seems to me as though people feeling good about making a profit and enjoying where their money is another thing. Oh, gold and silver. Yes. Gold and silver are interesting ones, because it depends which one there are. There are ETFs, which is an exchange traded fund. It's a name for a thing that is a type of fund. It depends whether you're holding virtual gold or real gold. There are some fairly significant issues around the environment. There's definitely some significant issues around workplace practices when you come to mining. But if you're tracking the price of those things, then that's possible to do. Going back to the comment about indices with Vanguard and with BlackRock, it is possible to invest into or hold something that simply follows the price of gold. So that if you think that precious metals is going to be a thing, you could find that it's like gambling. You can gamble on anything. You can find an index on pretty much anything as well. So if what you wanted to do was to follow an index of precious metals, it would be possible so to do. If you start investing into shares in gold companies, that's a whole other world, and I don't know how they would do.
Genius, but they must do something with the money you give them. How do you know if that is ethical? So
this is the thing that they actually don't. So they don't. They simply hold the money and they track it and they follow, and effectively, so they're not buying gold, or they're not buying the companies that make up the FTSE 100. They simply have the money and it is held, and they won't, in many cases they won't even be investing it, because they can't afford to take the risk. Because if they were to invest that money into something else, and the thing that they have chosen does terribly well or terribly badly, and they've got to pay you back, and the thing that you've chosen has done terribly well, then they have a bit of a gap there between what they expect and what you're going to get. Oh, now that's an interesting question. I got the We Curate a Marquee.
Jeremy has put, we curate a marquee left to us by our lovely neighbour, alas long deceased, regularly used for community events. The gift has proved a fine investment in friendship. Just a thought. Thanks for an interesting session and must go. So I think what he's saying is it's not always about money, what you invest in. It's time and neighbours and communities and similar things like that. Which obviously is
the best part of my job is not the part where I'm talking about money, because it's just not. The best part of the job is either finding out people who, I've got a very wealthy client who sold his business, who doesn't agree with animal experimentation. So what he did, because he's rich enough, he is funding a small number of PhD students at Cambridge to investigate alternatives to experimentation, so non-animal experimentation. Can you imagine how enjoyable and interesting it is to talk to him, rather than saying, well, as you may have noticed, the interest rate has been stuck today because the Bank of England has changed its mind. It's like, yawn. And the value of stuff is greater than the value of money. So I completely agree. I think the that element, the benefit you can get from a small amount of gifting. The point that somebody made, that the personal benefit of doing something for no other reason than that because it's an act of kindness is extraordinary. And we have a charitable foundation at work which we use and which clients use as a conduit so they can make anonymous donations and contributions and stuff. That's much more enjoyable than talking about why it is that the market went up by 3 or went down by 3 in the last 6 months. It's also quite fun meeting people who are paying or sending food parcels to people who got locked up because they were on a march with them against Extinction Rebellion. But I get quite a lot of that going on as well because we have quite a lot of clients who are quite radical.
Okay, well, we're coming towards the end of our session.
Yay!
Oh, here we go. There's a charity that does that. What, sends food parcels? No. I have to wait for a bit of typing to go on.
You will.
So,
what, sends parcels to people in prison?
No.
Okay. Okay. In the world of the completely not linked to this, but I don't know if you saw today. You know the young man who broke out of prison? He was in court today and he pleaded not guilty to breaking out of prison. I'm sorry. What? So you're still in prison? Oh, you are still in prison, aren't you? Fair enough. So you just took a brief. It was a sabbatical.
I think Jeannie's just typing as you're speaking. So she has put, are you going to circulate contact details? We will certainly do that. I'll make sure that's alongside the Dr. Hadwin Trust provides investment to medical research that doesn't involve animal testing. So there are other.
Yes. The client I referred to has been giving money to Dr. Hadwin for years. Dr. Hadwin are fantastic. We've always been, yes, we love them. Love them to bits.
Yes. So, but yes, certainly we'll make sure the contact details for ethical investors are circulated to everybody. And obviously, sorry.
If you want another topic to, and you're feeling like you want to do something interesting, all of the stuff that goes on around research and information and stuff and around ESG, nobody ever enough talks about tax. It's kind of odd. So whether it be the environment, whether it be social issues, etc., the most important thing is that companies, individuals, it's quite difficult to avoid paying tax. Companies are very good at it. So if you want to pose some difficult questions to companies, ask them, or if you've got money invested, ask the people with whom you have money invested what they do about tax and what questions they ask of the companies that they invest into. It's a bit of a thing of mine at the moment because it just seems like there really is this situation where we've got a bizarre mismatch. Everything that we need is more and more expensive and needs government spending, yet governments think it'd be a good idea to cut taxes. And wouldn't it be a good idea? We don't actually need to increase taxes. We just need to make sure that people pay them. So strangely enough, what about asking the people of whom you are a customer or where you're invested, if you'd mind them telling you whether or not they pay their taxes, where they pay their taxes? Have they signed up to any of the tax agreements that are out there? If you want to get really silly, ask them if they do country by country reporting, because that's what you need. If you know that people have got nobody employed in Panama or in Mauritius, and yet they seem to have an office there and they're channeling profits through there, that might be because they're trying to minimize how much tax they pay. Could have a whole day talking about that, but that's another matter entirely.
Okay. So thank you.
Noticed, it's the men that are leaving early, not the women. Isn't that a thing? They all need to go to the toilet. That's what it is.
Yes, if everyone paid the same percentage of tax on their income, we wouldn't have any problems at all. Yes,
yes,
I think there was.
If companies paid the tax that they need to pay, they
Yes.
always say, "Oh no, it's the shareholders and all the rest." Well, we're the shareholders.
Yes.
You know,
Yes.
if you haven't noticed, it's quite expensive to go into a care home, but we don't, and it's quite expensive to run a hospital, but we don't need tax, do we? So let's cut it. Okay, good. It'll end well, I think.
Okay, well, as I say, we are getting to the end of our session. So thank you very much to everyone for coming along and for some very interesting questions.
Yes.
I think what I've very much taken from this is that even as an individual, if you approach your investment provider, your pension provider, wherever your money is, and just start asking them questions about what they're doing with that money, they're not going to want the adverse publicity. And if a lot of individuals do it, then it really starts to have an effect. So we all ought to be a little bit more proactive in asking questions and rooting out answers, rather than just sort of passively accepting that our money is invested and we can't do anything about it. I think that's one message I've taken very clearly from this session.
Someone's just asked about modern slavery.
Yes, yes.
Modern slavery is okay. It's extraordinary, isn't it? People say, "Oh, do you know what? I can go down there, I can get my car washed, and it only costs me £6." Well, I wonder why. Because if you work out how long it takes to wash a car and how many they can do in an hour, and the fact there are 4 people there, mostly Albanian, it seems, it's probably because they don't get paid very much. And it is an extraordinary thing. It's not a long list. One of the good things that Theresa May did, she was quite good on women and girls. She was quite good on modern slavery. The rest of it, not so much. But the legislation is there. It is an extraordinary thing that we still have a situation where, and the other one, which I love, which is, have you noticed that clothes have got cheaper and cheaper? Well, I wonder why. You know, it's not because people who are working in Rana Plaza out in Bangladesh are being paid well. Somebody has suggested that what needs to be done there is very simple, which is there needs to be a label. There needs to be a minimum wage for people there, and if the minimum wage isn't being met, there should be a label on your clothes saying "made using slavery," because then people wouldn't buy those clothes anymore. You wouldn't see them going into Zara, buying an outfit and then binning it the next day because they only wanted it for a day. Modern slavery is something that it's very interesting. I mean, the person who brought the question up, that when that happened with the garment factory, the fire out in Rana Plaza, the reaction of the investment industry was absolutely fantastic in the main, because what they did, they were quite happy to name names. And it is difficult because if you are a manufacturer in that space, you are given all these assurances. You know, Marks and Spencer are pretty hot on sourcing, on food and on clothing. And if you have local partners who absolutely assure you, and you carry out inspections and everything else, and it turns out that they have a dummy factory or they have something going on that you aren't aware of, it's incredibly difficult. It's a bit unfair that they get caught for it. And they keep driving these things to change. But the reality is, when Rana Plaza happened, it led to a very interesting situation where people realized that some of the high street was incredibly enlightened about these things, and some of the high street really wasn't. And if you want to look at modern slavery as an issue, take a look at how some of the organizations that are on the high street, how they react to initiatives that people try to bring in about doing something about that. And the ones who react well are the ones that you are more inclined to go and shop at, and the ones who don't react well are the ones that you think, oh, I won't shop there anymore then, because fundamentally they don't seem to be all that bothered. And some of them seem to be making rather a lot of money, might be based in Spain, not saying any more than that.
Nope. M&S now have a lot of clothes made in China, not a good option in my view. No, I mean, they always used to say their stuff was made in England, didn't they? So, yes.
Yeah, we outsourced all of our manufacturing, didn't we? China's a very difficult case in that I don't think there's anywhere the clothes are being made where the human rights or the labour rights are particularly marvellous. So that's not to defend China, because it's quite a difficult one. On my iPad, that's actually made in Taiwan, so that's okay. Probably made in China, maybe made in India now. It is a very complicated world. That wouldn't it be nice if you could buy clothes made in England? Mad idea. And the thing I never understand, which is why are there so few factories, or recycled clothing, why are there so few factories in the global south? It's very odd, isn't it, that if you think the places that you see your clothes being made, they tend to be, it's either Turkey or further beyond, a little bit of Portugal, but mostly it's it's oh please, my precious metals. You mean the ones that came from the DRC? Don't even. They're not precious. They're rare. That's not the same at all. And you know, okay, because I only found this out recently. I thought they were called rare metals because they're not that common. They're called rare metals because that's what they are on the chemical table. They're under rare. That doesn't mean they're everywhere, but if you're going to do the DRC thing, we'll be here until Christmas.
We have got 2 minutes.
Well, I'll stop throwing nonsense comments in, and I'll stop. And you can all have a lovely evening. Thank you for coming. It's been fun.
Well, thank you very much, Mike, for a very interesting, very engaging, entertaining presentation. As I say, we will circulate details to everyone, and in time, hopefully not too long, this recording will be on the HGN website. I have to give a plug for HGN. If anybody isn't a member of Herefordshire Green Network, please do sign up. It's hgnetwork.org, and you go to our membership page. We are only kept going by our members, so please do support us, and you get a very, very interesting weekly newsletter done by yours truly. So thank you very much. Thank you again to Mike, and I hope to see many of you at our next gathering, which will be in October. I'll circulate the date later, and that will be on e-bikes and how they are getting increasingly prominent in society, and their uses and so on. So, okay.
And they are fantastic. I bought one at the beginning of the pandemic, and I absolutely love it. I bought a lightweight mountain bike, and it is fantastic.
So, well, there you are. You can join our next online gathering. So
I can be the example. Well, the great thing was, you see, because during the pandemic, I was a key worker because I had to go into the office to open the post. So I cycled, because I got an enormous hill between me and the office. So that was that. I had my defence ready in case I got stopped as why are you a key worker? Well, remote working, tax year end. Have a lovely evening. Thank you very much.
Okay, thank you very much, everybody, for attending. Thank you.
Okay.
Bye-bye.
Bye-bye.
Bye.